Hello and welcome to the Freight FA Brief. Today, if you care about export flows and where the next real freight gateway is being built, you should be watching Mobile, Alabama, because a Montreal-based logistic player, RAY MONT Logistics, is investing real money on the ground at the port of Mobile. They're building an export-focused transloading facility projected to move about 60,000 TEUs per year once phase one is up and running. On its own, that's a nice project. In the context of a deepened 50-foot channel, a new 1,300-foot berth, and a port quietly upgrading to a 1.4 million TEU terminal, it's something else entirely. This is not just Mobile gets a new facility. This is more like Mobile is trying to rewrite its role in Gulf Coast exports. Let's put the basics on the table. RAY MONT Logistics, based in Montreal, has begun construction on a new export-focused logistics facility at the Port of Mobile. It's a transloading terminal built primarily around plastic resin packaging and forest products. Those are two categories that live and die on how well you handle bulk, bagging, and port handoff. Phase one of the facility is scheduled to open in the fourth quarter of 2026. Once it's fully ramped, we're talking about roughly 60,000 TEUs of export volume a year tied to this project alone. Now, if you zoom out, the Alabama Port Authority and APM terminals in Mobile are moving forward with a new 1,300-foot container berth, which is about a 400-meter extension that will increase berth capacity by 50%. Once that's done, APM terminals will be able to handle 3 ultra-large container vessels at the same time, with annual berth capacity reaching around 1.4 million TEUs, supported by 7 ship-to-shore cranes. And it's all built on a 50-foot deepened channel, now marketed as the deepest container harbor on the U.S. Gulf Coast. So in one corner, you have RAY MONT bringing in export-focused transloading. In another, you've got APM and the Port Authority investing in channel depth, berth length, and rail-served terminal capacity. That's not a coincidence. That's an intentional stack. Let's talk about why this should matter to you if you run trucks, manage a network, own assets, or deploy capital in this space. First, cargo mix. RAY MONT is not building a generic box-moving shed. The company says this facility is designed to support plastic resin packaging, forest products, and other export cargo. Resin, in particular, is one of the most important export stories on the Gulf Coast right now. Volumes are big, the flows are sticky, and they're heavily tied to petrochemical production and global demand cycles. Second, inland connectivity. This isn't just somewhere near a port. The facility is being built on the property owned by Alabama Export Railroad, designed to plug into the port rail networks and connect inland production into Mobile's container terminal. CN has openly framed this as a way to leverage railway access, APM terminals, global connectivity, and Mobile's growing export role in one move. Third, timing and reliability. APM terminals didn't greenlight a $131 million berth project for fun. The point is to reduce vessel wait times, increase flexibility, and strengthen schedule reliability. When a port is telling carriers, we can take 3 ULCVs at once and turn them efficiently, that really changes service design. Now add RAY MONT to that picture. In fact, RAY MONT's president, Charles Raymond, called the Port of Mobile an increasingly important gateway for global trade, and said this project is about building long-term value around that momentum. You see, that's a logistics operator effectively saying, we believe this port can support dedicated export infrastructure and customers. So if you're an operator, you don't care about ribbon cutting photos. You care whether the stack reduces touches and it shortens dwell. Also, if it creates another credible routing option for your network. Okay, let's take a quick pause to talk about something that sits right at the intersection of this story. I want to talk about Freight Flow Advisor from Freight FA. If you're listening to this and thinking, okay, Mobile looks interesting, but what does that actually do for my freight costs? That's exactly why we built Freight Flow Advisor and Freight FA. You see, it's a chat-based freight intelligence layer that lets you stress test lane decisions when new gateways like Mobile come into play. You can compare routing scenarios like Houston versus Mobile. You can also get AI-powered pricing guidance that isn't just a spot quote, but provides you with context around the market shifts, infrastructure changes, and network design. Now, you can get all of this instead of digging through PDFs and rate tables and news articles because we've done all the work for you. Freight Flow Advisor just pulls that into something you can work with in real time. So, whether you're a shipper, a carrier, or an investor looking at the economics of a project like Ray Mont, you want to get beyond the headline into the actual freight math, pricing, routing, and network scenarios. So check out Freight Flow Advisor at freightfa.com. So as we zoom back to the story and we start stripping the press releases away, this all boils down to a few simple questions for operators and executives. One, does this make mobile a real alternative in your routing, or is it just a nice to have option for certain customers? When we look at resin and forest product exporters, it's pretty clear that it's moving into a real alternative bucket. You've got inland production, dedicated transloading, and packaging via Ray Mont, rail access through the Alabama Export Railroad, and CN, and a deep channel expanded berth complex on the water side. That combination matters more than any single investment on its own. Channel depth without cargo specialization is just potential. Transloading without rail is constrained, and a new berth without volume is a stranded asset. It's when these pieces all line up that it starts to become defensible for freight flows. The second thing I think we need to look at is what this means for drayage and trucking. New export volume, and especially containerized resin, doesn't just create port jobs, it creates short haul movement opportunities around the port, repositioning, and demand for capacity that actually understands the nuances of export timing. If you run assets in the Southeast or the Gulf, Mobile is moving up the list of markets where being early might pay off. Third, we need to look at how this shows up in pricing and procurement. It's not overnight, but once the facility opens and service patterns stabilize, you can expect Mobile to start appearing more often in RFPs, in network optimization runs, and in conversations where shippers ask, what else can we do on the Gulf that doesn't depend on one or two mega gateways? That's where tools like Freight Flow Advisor become really important because you need to be able to model when shifting 5, 10, or 20% of volume in a place like Mobile actually improves your outcome versus just spreading yourself thin. So let's close with a simple framework. We're going to look at bull, base, and bear scenarios for what this could become. Starting with your bull case, Ray Mont opens on schedule, Q4 of 2026. The ramp goes smoothly. Resin and forest products volumes start to materialize. APM's berth and ongoing rail and yard investments translate into real improvements in schedule reliability and vessel turn time. Now, in your base case, the project opens roughly on time, but adoption is gradual. Shippers test Mobile with a slice of volume. Operators feel it, but it's a more credible niche than a game changer out the gate. Mobile becomes the smart alternative for certain lanes and commodities. Now, if we look at the bear case, which I feel is a slim possibility, the facility opens late or below expected capacity, cargo onboarding is slow, and the promised network benefits from the channel, berth, and rail don't show up as cleanly at operating. That would make Mobile interesting, but most routing and procurement behaviors remain anchored to existing Gulf and Southeast gateways. In my estimation, the reality will probably land somewhere between the base and bull case. But here's the key point. Even if you never move a single container through Mobile, you should be treating stories like this as input into your freight model. Because when ports move from regional to strategic option, it changes how carriers design services, how shippers bid freight, and how capital flows into or out of competing gateways shift. So look, in closing, Ray Mont's new facility isn't the biggest project on the map, but it's exactly the kind of signal that tell you where the next pockets of freight opportunity might be. It gives you pricing leverage and network resilience might start to show up, especially if you're in exports like resin or forest products that touch rail connected supply chains. If you want to take this story a layer deeper for your own network, go run it through your models or let Freight Flow Advisor do the heavy lifting for you. I'm going to leave it there. Thanks for listening today. And if you've enjoyed the show, make sure you share it with a colleague. Now listen, each one of our podcasts comes with a curated article. Just head over to substack.com and search the Freight FA brief, where you'll find in-depth analysis for you and your counterparts to review. While you're there, make sure you hit subscribe and give us a share. You can listen to this podcast on Apple or Spotify or you can watch us on YouTube. If you're on social media, you can find us at the Freight Flow Advisor on LinkedIn, Facebook, and Instagram. Until next time, this has been your Freight Flow Advisor Brief.